Welcome back to this afternoon session of personalized portfolio management for high net worth clients. And of course, the presenter we have here today is Chen from Mercury Private. And a quick introduction on Alan. So, I had the privilege to work with Alan for the first time 18 months ago, rough about. And prior to this engagement, he has never used or seen Tier 1 ever before. So that kind of leans into what we're going to be talking about today, or what Alan's going to be presenting today, which is what they're using Tier 1 for. And for this specific use case, I think is a great example of how Tier 1 can really help with harnessing complexity, doing all the heavy lifting. So valuable time can be spent on more valuable activities. And with that introduction, I would like to pass over to Alan.
Thanks very much, John. I'll bring up my slides now. Okay. So as John mentioned, my name is Alan. I am a project and business analyst at Mercury Private, and I'm coming to you from Sydney, Australia. Today, I'll be talking to you about portfolio management for high net worth clients. Now, before I proceed any further, I must start off with some disclaimers. The information in these slides is for general information only. It should not be taken as constituting professional advice. I am not a qualified financial advisor. You should consider seeking independent legal, financial, taxation, or other advice that relates to your personal circumstances. Mercury Private is not liable for any loss caused arising from use of information in these slides. Okay, so a good starting point for us today would be to talk a little bit about Mercury Private and what we do for our clients. Mercury Private is a wealth management firm. We specialize in servicing high net worth individuals and family offices. Our client base is unique in the industry. About 3/4 are drawn from the medical, legal, and dental industry, with the balance being corporate executives or retirees from the aforementioned occupations. Now, our services are spread roughly across 6 areas, the first being investment advice and portfolio management. We also do work on strategic and structuring advice that includes broader balance sheet work, such as assisting our clients purchase investment properties, legal chambers, or medical practices. We also do work on risk advice, that is insurance, tax and accounting, estate planning, and philanthropy. One of the key objectives we try to achieve for our clients is to maximize post-tax returns. And that is really embedded within the first 2 service offerings that I've got on this slide. And today's presentation will be a demonstration on how Team 1 has helped us achieve this in the context of portfolio rebalancing. To help you understand this further, let's take a look at some different investment business models. So we begin with a unit trust, and Mercury Private does not use this model. A unit trust is relatively simple. You have investors who would put cash into a pot. In this case, we've got multiple investors investing cash. It goes into a pot, and the pot will invest into different underlying securities. So in this example here, I've got an active growth asset allocation. And that would be spread across lots of different underlying securities. It would include Australian equities, international equities, property, fixed interests, and the like. In exchange, investors will receive units. Now, unit trusts are great for many reasons, including the fact that they are simple to administer. It's also offering investors an access to a diversified portfolio. You also don't need a lot of cash to get set up, and there are lots of options available on the market. So this example here being active growth, you would have balanced, high growth, sector-oriented ones, ESG-oriented unit trusts, and the like. So there are plenty of options available on the market. The downside to unit trusts is the fact that there is a lack of personalization or customization. So the difference between a relatively small investor and a much larger one would simply be the number of units or the quantum they invest in the unit trust. There is little to no other differentiating factor. And as a result, investors who go with this structure might feel like they've lost control of their assets. I'll give 3 examples to illustrate. The first, you might have one investor over here who doesn't want to realize any capital gains for the year. The trustee, so the person in charge of managing the asset pool, they will continue to buy and sell and rebalance the asset pool according to their investment mandate. And that's not going to take into account the personal circumstances of any of these individual investors. Secondly, these investors, they would have very limited visibility as to what goes into the asset pool. Often they would display, for instance, the top 5 or the top 10 securities, but the rest of what goes into the pool, the rest of the underlying securities, that is quite obscure. And as a result, a client might feel very strongly or against inclusion or exclusion of particular securities, but again, they don't have control. So what is the alternative? The alternative is we can take a look at individually managed accounts. And this is the model that Mercury Private administers. So you can immediately see from here the different color coding, meaning that investors would invest cash and the securities would directly be held under their own name. And this would be different for each of these investors. These are essentially separate pots, and hence the name individually managed accounts. Now, the construction of this is highly personalized. To set these up, the investors would speak with an advisor or a portfolio manager and understand their circumstances to come towards a core investment strategy. So some of the factors that you might take into account would be, for instance, income and growth requirements. You might have one particular investor who highly prefers capital preservation and income requirements. And that's where you can structure the securities within this particular box to accommodate that. You could also take into account liquidity requirements. For instance, if you have upcoming expenditure, that could be setting money aside for a house renovation or, for instance, for children's education funds. And that's where you might change the composition of this box to have higher liquidity and overall have a safer investment profile. Other factors you might take into account could be risk concerns, taxation status, investment restrictions. That's quite common for us, where we have clients who are directors on boards of ASX companies and they've got trading restrictions in place. So again, that's where this pot, we would note the trading restrictions that they've got. And lastly, you can also take into account ESG considerations. So the portfolio would be tailored for the client. And as you can imagine, with each of these being separate and unique buckets, it can be quite a challenge for us to administer this. So that takes us to our business problem. Mercury Private has over 1 billion in investment assets under management, and this is split over 190 client groups and 650 individual portfolios and accounts. So think about it as 650 of these individual unique boxes. To do our portfolio rebalancing, we need to take into account lots of customization and edge cases. And so it is quite a complex task in itself. And as a result, we needed to look out to the market to find a tool that would help us to accommodate this. And some of the objectives we had in mind, I've got listed here. The first being, with so many different individual accounts, and that number only growing more over time, we would need a dashboard to give us insights into which accounts fall out of line and which ones are essentially the exceptions that need to be processed. We would also need an interface to do the portfolio rebalancing itself. Ideally, the tool would be scalable with other queries, and it would be flexible enough so that we would have control over the development. So if we do come across future edge cases, we would be able to address that as opposed to being limited by third-party development. And we would also like the tool to help us reallocate resources more efficiently and help us maintain our profit margin. Now, these objectives here will come to life over the coming slides, but I do want to spend a little bit more time talking about the last point here, maintaining profit margin, and how TM1 has helped us with that. So the market has a lot of portfolio rebalancing software, and this would include higher end tools, which do come with all the bells and whistles in order to help us with our customizations. So there's no doubt about the functionality there. But in order to bring into effect portfolio rebalancing, you would need to take into account all of the client's assets. That would include listed or open investments. It would also include unlisted closed investments. And the uniqueness of Mercury Private's asset allocation means we have a significant portion of unlisted investments. That would include unlisted property, unlisted alternatives, and private equity. And the goal of that is really to reduce correlation between the securities in our client portfolios in order to achieve a higher risk-adjusted return. So again, we need to put all of this into the system, all of the assets under management into the system in order to do portfolio rebalancing. Now, software on the market would charge a percentage of assets under management. So they would charge on this entire pool. But as you probably could have guessed already, only the top half, the listed or the open investments, these are portfolio rebalancing applicable. So these are the ones that you can trade freely on stock exchanges. They're also the ones that are open for new applications and redemptions. Compare that to the unlisted ones where you can't rebalance on a regular basis. And so we're posed with the business problem where we need to put everything into the system, but we can only really transact on the top half. And so it's not necessarily sustainable from an EBIT point of view when we look at external software on the market that charge as a percentage of assets under management. There is also other software that would charge based on the number of client accounts, but again, that is not sustainable as our business continues to grow. You compare that to, for instance, TM1, where the cost of TM1 licenses is relatively fixed. And once you build out the query, you can use it as many times as you like. You can also feed in as much data or as many different clients or accounts, and the marginal cost is next to zero. So that is the tool selection process from a profit margin point of view. Now I'm going to talk a bit more about TM1 in terms of functionality, so how it has actually helped us to execute on portfolio management. We begin from the start, which is the data collection process. In order to bring portfolio management to life, we need to collect a lot of data sets. This would come from our CRM. It would come from external advisor portals. It would also come from our in-house research team and spreadsheets within our local drive and the like. So there are lots of different sources. This data would include, for instance, our client lists, the accounts themselves, bank account balances, any cash flow requirements or special considerations we need to take into account, the assets under management themselves, and our model portfolio. So what we are trying to work our clients towards in terms of the target weightings for the securities we recommend them. Now, typically, or under the old process, the advisors would need to go out to all of these different systems to collect the information. They would run some spreadsheet model and do the portfolio rebalancing for one client. If another advisor required portfolio rebalancing, again, they would need to replicate the steps. They would need to go out to all of the different systems, collect the information, massage it in Excel, and complete rebalancing. This is not very scalable because it means replication of work each time. So by putting it into TM1, we can essentially load the data in bulk. We now have a data administrator who will collect this data for every single client. And what that means is the advisors can simply click into the client and the information will already be there for them. This has considerable implications for both data quality and consistency. And it also means we're shifting the data collection work from a higher cost advisor resource to a relatively lower cost data administrator. Once we put the data into TM1, we can make use of groupings and hierarchies. So here on the left, I've got 4 individual accounts, each of these holding different securities. It could be, for instance, the client, the partner, the super fund, and a family trust. But we might choose to consolidate these 4 together and treat them as one. I've got a relatively more complicated case on the right with client number 2. Again, we've got the same 4 portfolios here. But on top of that, we've also got a charitable trust. We've got children's education portfolio and perhaps the children's super fund as well. And notice the slightly different groupings here. And the reason for that would be because of the custom mandates. So for instance, children's education portfolio, as mentioned earlier, that might favor higher liquidity. It might favor capital preservation. And because of that, it's going to have a separate mandate. The way we would measure performance and the way we would do portfolio rebalancing, that is completely separate to everything else that is happening up here within the main group, which is why we would separate it out. And the same could apply for a charitable trust or a foundation, which is essentially donated money. So that's the groupings for the clients. We also put in model portfolios, and these would differ depending on client characteristics. So we've got wholesale and retail investors. Wholesale investors would typically have a much larger investment universe. They would have access to different securities that retail investors otherwise would not have access to. So we've also got different model portfolios depending on the risk profile. So balance being relatively more conservative compared to growth. Now, within each of these model portfolios, so using the example of a wholesale balance portfolio, we can see the different investments. That's made up of the underlying securities being Australian equities, international equities, fixed income, property, and private equity. We also load in investment keys, and this is our in-house research. This comes from our in-house research team where they have different views on different securities at any point in time. And that just shows that not only are we bringing clients closer towards their targets, but we're trying to do it in a more opportune way where we take into account the prevailing market conditions. So a key of number 1 here would indicate a strong buy, a key of number 3 here relatively weaker. There are some other securities. These would be the unlisted ones where there is no investment key simply because you can't buy in and out of them easily. So combining these two elements now, we've got the clients and the model portfolios. We basically assign the portfolios to the groupings. And going back to my earlier example, we've got a client here who might have a growth profile, but we might be more conservative when it comes to the charitable trusts and children's education portfolio. So these two here would be assigned a balanced portfolio. On the flip side, children's super funds, with these having much longer investment terms, we can ride out volatility over time, and that's why we might choose growth or even high growth. Okay, so now let's delve a little bit deeper as to how we actually assign the underlying securities. We have grouped 4 clients together here in client number 1, and each of these portfolios will have different characteristics. The example I have here is the client and partner who are both on the highest marginal tax rate. So that's tax rate of 47%. We also have a super fund, which, assuming it is in accumulation phase, will have a tax rate of 15%, and a family trust with a tax rate of 30%, assuming that it is a corporate beneficiary and it's paid at the full company tax rate. So we've got different portfolios with different characteristics, but what we are saying here is, as a whole, when we consolidate all 4 of these portfolios, we need it to be close to or towards the wholesale balance model portfolio. But the underlying constituents, so what goes into each of these accounts, that can be unique and that can cater for depending on the tax circumstances. So for a high tax rate entity, you would want to be overweight growth securities. You would want to make use of the fact that there is CGT concession. So that's where if you hold securities for a period of longer than 12 months, you would pay half the capital gains. And the flip side to this being where the high marginal tax rate entities would not want to hold income generating securities. The reason being it's any additional income you make that's going to be charged or that's going to be taxed at 47%. And so if I focus here on 2 specific securities, the way I would align them is to move the fixed income into the lower tax rate entity and the relatively high growth international equities managed fund into the higher tax rate entity. And you can continue this method with all of the different underlying securities such that, again, overall, when we add everything up for all 4 portfolios, it adheres to the wholesale balance model portfolio. But that's the underlying mechanism of doing the rebalancing, where we try to assign securities into different portfolios to maximize the post-tax outcomes. But in terms of the advisors actually going into TM1 to do it, we would first off need a dashboard, one that would highlight exceptions in asset class and security weighting. So basically a dashboard that tells us which clients we need to rebalance. The example I've got here is one client, and I've got 5 points. So let's start with the first one. This negative 26%, that would tell us that client 1 is 26% below their target for Australian equities, or in other words, they hold 3/4 of their target. And within that, they are over their target in 4 securities and under their target in 8. Now, importantly, this would take into account minimum deviation limits. So when you have a portfolio reach a certain size, you wouldn't rebalance until the deviation becomes material enough. So just to throw a rough example, if you've got a $5 million portfolio, you're not going to recommend the client to do anything unless the deviation exceeds, for instance, more than $15,000. It also takes into account investment keys. So if you recall from my earlier slide, we have investment keys from the research team. If a stock is a very strong buy, then even if a client is overweight in that stock, it's not going to flash up here because we're not going to sell it down. And all of this is dictated by the underlying global assumptions, so we can change this depending on the circumstances at hand. Number 3 here, international equities, that is blank, which means we are within the acceptable range for international equities. Number 4, the non-model portfolio, that is what Mercury Private does not recommend. This could be legacy securities that the clients have brought on, or it could be securities that the clients have dictated themselves that they want to purchase. And we just take a look at how much of the total portfolio that comprises of. And lastly here, available cash, that is saying how much cash we have to work around with. So if a client is underweight in a particular asset class, we would check, is there cash to do anything about it? Or otherwise, do we need to sell down other holdings in order to fund new top-ups and buys? And this available cash calculation, there's actually a lot that goes into it. Besides taking into account bank account balances, it would also take into account money that's held for outstanding recommendations, outstanding capital calls, insurance payments, direct debits, and there's a lot of information within here. You would be able to right-click this and drill in to see the calculation behind it. So this is for one client. We can extend this to give us the broader dashboard, and this will again respect the groupings and hierarchy. So you can see here, client number 6, that would, for instance, include the client, partner, super fund, and trust, which is one grouping. We've also got the charitable trust as a standalone, plus the 2 children's super funds. This being a dashboard, the advisors can come into here, filter for their own clients. They can also sort. For instance, they might want to see who deviates from the Aussie equities asset allocation by the most. They could also sort for based on available cash, so who has cash to deploy into investment securities. From the dashboard here, the advisors would identify a client that they want to rebalance, and that would take them to the next screen. So all of this is within TM1 Web. The next screen, client number 1 here, I've gone into the portfolio rebalancing screen, and this again will aggregate all the information. It's got the client portfolios, it's got the tax rates for these entities, the securities that we are recommending, whether they currently hold it, what the target is for the group as a whole, the cost base, and sorry, here's the target, and that's the cost base, and across on the right here, we've got the deviation. So the way an advisor would read this is client number 1 is currently under our recommended target for Amcor by about 54,000. And so we would type in the yellow section. If it is an appropriate recommendation, we would buy 54,000 here. And you would be able to see here the under and overs. That is what this dashboard here relates to. And again, anything that flashes as under or over, that should be actionable based on security deviation from the target plus investment keys. Once the recommendations have been made, we can click across to the next screen, and that is going to give us our summary table. So here's just a small sample of the summary tables. We've got a summary of the transactions we have recommended, the effect on the target weightings, and we also take a look at the weightings on an asset class, both on a consolidated and individual portfolio basis. These summary tables will then go into a formal letter of advice, which we would send to our clients. I should have mentioned earlier that with individually managed accounts, we run, so we need to add the two words non-discretionary in front, which basically means we don't have discretion to buy or sell on behalf of clients. We require client authority to proceed, which is why we need to take the rebalancing output, put it into a formal letter of recommendation, and then receive client authority to proceed before we place the trades on the client's behalf. And so now I'll come back to this screen, which should look familiar. Hopefully, a lot of the dot points here now make a lot more sense now that we're reaching the end of the presentation. Again, the business problem is we've got all of these different accounts. Each of them hold different investments. And the fact that clients can choose to accept or decline our recommendations really means that these individual portfolios will differ even more over time, depending on client circumstances. The number of clients are also going to grow over time, and there may be new customization or edge cases that we will require in the fast-moving finance environment. And so whilst looking for the tool, we searched for these dot points here, and I'm quite confident that TM1 has been up to the challenge and has been able to successfully tick these off. Okay, so that brings me to the end of today's presentation. Thank you very much for your time.
That's excellent. Thank you for that. At the moment, we don't have any public questions yet, so I've got a couple of questions for you. If you are in the liberty to answer them, love to hear what you have to share.
Fire away,
Otherwise,
John.
I don't understand, because this is a sensitive area. So I guess the first one is, in some of the cases where you use TM1 to automate the calculations and data consolidation, how much time has it saved? Is it something quantifiable in your experience?
I think in terms of quantify, I'm not able to give you a number for that, John, but I think TM1 really has opened up new possibilities for us. So the main one being that overall dashboard to really flash out the ones that are red for us. So previously, we would, for instance, do it periodically. A portfolio rebalancing would follow anytime we would meet with the clients or before we would meet with the clients. And in doing so, we really need to crunch the data, go into it before we can see any immediate red flags or pain points where we would need to go into rebalance. So that being said, like the work was done, but it's more, this gives us information access at any moment's notice. So what we find with our advisors now is they're often going into just take a look at the dashboard, going into drill into the data, but often coming out of it just saying that there's no action required. So we don't actually need to do anything. And the reason for that is because there's such a low cost to accessing the information. It literally takes 20 seconds to go in to take a look at whether the clients are in line with their model portfolios or not.
That's excellent, because that gives them a lot more opportunity to make informed decisions.
Yep, absolutely. We wanted the advisors to spend more time analyzing portfolios and making recommendations as opposed to doing the data collection.
Yeah, data collection. And I might have time for one more question, which is, within half a minute, would you be able to summarize in your own experience, how has TM1's journey been for you personally?
Well, TM1, it has been a bit of a roller coaster for me, as you can imagine, John, because I didn't have any prior experience, and neither did anyone here at Mercury Private have any experience with TM1. And to be honest, initially I was a little bit skeptical. I mean, the work involved with getting the IT up and running, plus doing all of the data standardization just to run one query. But it quickly became apparent that subsequent queries would draw on the same data set, so there's significant scales there. And you can also run the query as many times as you would like. The information's all there. It's just a different cut of it each time. So, I mean, I think we are over the initial hurdle. As you said, we've been at this for about 18 to 20 months, still very new to it, but I'm confident that we can accelerate the roadmap moving forward.
Yes, and it's worth noting too, when we mentioned I have started working with you 18 months ago, is not 18 continuous months. I guess to set the expectations of some people who are watching who doesn't have this info,
Yep.
we kind of do a little bit of work and then we let rest, let you guys get good value out of the system, and then we continue on when you're ready, which is not a benefit of TM1. You can go one part at a time.
Yep, absolutely correct, John.
Okay, well, we're spot on 30 minutes. Thank you for your time. Thank you, Alan, for spending time with us and sharing your experience. And thanks to everyone who's joining. If you have any questions, feel free to contact our team, myself, Alan, and we look forward to see you in the other sessions or TM1 Horizon Sydney. So
Thanks very much.
have a good afternoon.